If silver was about to break out and the market suddenly went dark, would you call that a coincidence? Or would you start asking much harder questions? Because just hours before a critical deadline, the silver futures market didn't just slow down, it stopped. Trading halted, price discovery frozen. And it didn't happen during some quiet afternoon. It happened at the exact moment silver was pushing toward a crucial breakout level. Now, maybe it was just a technical glitch, maybe it was routine maintenance, but here's what makes investors uneasy. This is not the first time something like this has happened near a delivery window. Before we go any deeper, if you care about understanding the silver market beyond the headlines and the hype, hit that subscribe button right now. Because what we're about to walk through isn't theory, it's about the very structure of the market. This critical deadline is called First Notice Day, and it matters more than most retail investors realize. It's the moment when futures contracts stop being just numbers on a screen and get turned into real delivery obligations. In simple terms, it's when paper promises can become physical metal. And that transition is where stress in the system shows up first. When the silver market is calm, nobody pays much attention to this date. But when prices are rising fast and vault inventories are tight, that date becomes critical. So here's the timeline. Roughly 24 hours before First Notice Day, silver was trading firm, momentum was building, and the number of open contracts was high. Then, suddenly, the exchange reported technical issues. Trading activity was disrupted, and the entire metals complex went offline. But here's the interesting part. Natural gas came back online quickly. Other contracts resumed trading. Silver, however, stayed paused long enough to matter. Think about what that means in practical terms. No hedging, no rolling contracts forward, no price discovery during one of the most sensitive periods of the entire contract cycle. By the time trading resumed, the momentum had cooled. Orders were adjusted and market positioning shifted. The official explanation, technical problems. And to be clear, exchanges do experience glitches. Technology isn't perfect, but markets aren't just about what happens, they're about when it happens. Because timing changes everything. Now let's zoom out and look at the bigger picture. Silver is not trading in a normal environment right now. Industrial demand has been surging for years. Solar panels, electric vehicle electronics, semiconductor applications, all of these are pulling a steady supply of silver out of the market. At the same time, global mine production hasn't exploded higher. New mining projects take years to come online, not months. This means the margin between supply and demand has been shrinking, and shrinking margins make these delivery windows much more sensitive. Let's talk about inventories. Registered silver, that's the metal officially available for delivery against futures contracts, has fallen dramatically from its historic highs. While there's still a lot of what's called eligible metal in the vaults, not all of it is actively for sale at current prices. That distinction is crucial. The futures market depends on confidence. Confidence that if someone stands for delivery, the metal is actually there to be delivered. Most contracts never result in physical delivery. They're usually rolled over to the next month or settled in cash. But when the percentage of contracts demanding physical delivery starts to increase, the stress on the system multiplies. And recent months have seen elevated delivery volumes compared to historical norms. That fact alone raises attention levels on institutional trading desks. So imagine this environment. Elevated prices, a tight supply-demand balance, and rising interest in taking physical delivery. And then, just before that critical First Notice Day, the market halts. Even if the halt is purely technical, the perception of the market shifts. And in financial markets, perception is power. Some investors will see a coincidence, others will see a pattern. But serious analysts look at the data. The number of open interest contracts leading into this delivery window was substantial. If even a modest percentage of those contract holders decide to stand for physical delivery, the flow of metal out of the vaults could accelerate very quickly. Now, is this absolute proof of manipulation? No. Is it potential evidence of stress in the system? It certainly could be. Because stress in derivatives markets rarely announces itself with a loud bang. It shows up in subtle distortions. Things like rising lease rates for metal, premiums widening in certain regions, the physical market price diverging slightly from the paper futures price. None of these signals alone confirm a problem, but together they build a picture of pressure. And pressure always tests a system at its weakest points. Historically, silver has experienced some of its most violent price moves during moments of structural imbalance. This isn't necessarily because of some grand conspiracy, but because of simple market mechanics. If too many participants want physical metal all at once, the system has to adjust. That adjustment can come through much higher prices. Or it can come through things like incentives for cash settlement or even rule changes by the exchange. And this is why First Notice Day becomes so central to the story. Because on that day, contracts become decisions. Will holders roll their positions forward, or will they stand for delivery? That decision alone will tell us more than any social media theory. Right now, the market is watching the vault reports like a hawk. Every daily inventory update from the exchange carries more weight than usual because numbers remove emotion, and the numbers will either confirm that there is stress or they will relieve it. But here's what most retail investors often miss. The real risk isn't a dramatic overnight collapse. It's a gradual erosion of confidence. If market participants begin to believe that taking delivery is uncertain or will become prohibitively expensive, their behavior changes fast. Hedging patterns shift. Premiums on physical metal rise. Institutions quietly adjust their exposure, and once that behavior shifts, price inevitably follows. That is why this moment matters so much. Not just because a glitch happened, but because it happened at the exact intersection of tight supply, rising prices, and a critical delivery transition. That intersection is rare, and rare moments in silver's history have produced some of the most explosive moves ever recorded. Now, before jumping to conclusions, we need to analyze something critical. What actually happens if delivery demand exceeds the registered supply available? What tools does the exchange have at its disposal? What authority can be invoked? And what would it look like in real time if this stress becomes visible to everyone? Because the next 48 hours could either calm everything down and prove this was all just a technical hiccup, or they could confirm that something much deeper is unfolding in the silver market. Thanks for watching, and be sure to subscribe for our follow-up analysis. Now let's get into the part most people avoid. What actually happens if delivery demand exceeds registered supply? First, understand this clearly. The futures market is designed so that only a small percentage of contracts ever go to delivery. That's normal. But when delivery interest rises during a tight supply environment, the math changes quickly. If too many contract holders choose to stand for delivery at the same time, the exchange doesn't immediately run out of silver. Instead, it activates tools. And this is where things get interesting. Tool number one is incentives. The exchange or large counterparties can offer financial premiums to encourage cash settlement instead of physical delivery. In simple terms, we'll pay you extra not to take the metal. Most of the time, that works, because many traders don't actually want bars, they want profit. But if enough participants insist on physical, incentives become expensive. Tool number two is margin adjustments. Raising margin requirements can cool speculative demand fast. It forces leveraged traders to reduce exposure. This doesn't solve supply tightness, but it slows momentum. Tool number three is rule flexibility. Exchanges have emergency authority to modify settlement procedures in extreme conditions. This is rare, but it has happened in other commodities during stress events. Now here's the key point. None of these tools mean collapse. They mean control. The system is designed to absorb pressure before it breaks. But every time these tools are used, confidence takes a small hit. And silver is uniquely sensitive to confidence. Because unlike gold, silver has heavy industrial demand, solar panels, EV components, electronics manufacturing. If industrial buyers begin fearing supply instability, they don't wait. They secure forward contracts aggressively. That pushes physical premiums higher, even if futures look stable. And here's something many US retail investors overlook. Global pricing doesn't revolve around one exchange. If physical premiums in Asia begin rising faster than COMEX pricing, arbitrage flows increase. Metal moves where price signals are strongest. And when metal moves out of vault systems faster than it replenishes, inventory optics shift quickly. Now let's talk psychology. If this delivery window passes smoothly, volatility likely cools. But if delivery numbers spike beyond expectations, headlines change fast. Not because of conspiracy, because markets react to imbalance. Silver has only had a few historical moments where structural tightness triggered explosive repricing. And in each case, it wasn't gradual. It was sudden, violent, and liquidity dried up fast. Right now, we are not there. But we are closer to a structural tension point than most mainstream coverage admits. This is why the next inventory reports matter. This is why delivery statistics matter. And this is why timing around first notice day always deserves attention. If everything clears smoothly, the rally continues on fundamentals. If it doesn't, volatility could expand sharply. And here's the bigger picture. Silver near multi-year highs is not just a price story. It's a stress test, a test of paper positioning versus physical demand, a test of confidence versus structure. And markets don't need to break to send signals. They just need to wobble. So here's the question investors should be asking. If silver is this tight at 80+ levels, what happens if demand accelerates further? What happens if geopolitical tensions increase safe haven flows again? What happens if industrial growth surprises to the upside? Because the real shock may not be a crash. It may be repricing, fast, aggressive, and difficult to enter once it starts. That's why smart investors watch structure, not headlines. If you found value in this breakdown, comment below. Do you think this was just a technical glitch or a warning signal? And if you want real analysis on silver without hype, subscribe to Bullion Alert HQ, because the next move in silver won't come with a polite warning. It will come with volatility, and by the time mainstream media explains it, price will already be somewhere else